Good afternoon, everybody. Thanks for being on the call at such short notice. The trading update this morning splits into two basic parts. The miss that we're forecasting on FY25 and the view that we've expressed with regard to and guidance with regard to FY26. So I'll just take those two in order. So why are we forecasting a miss for 25 and why what's happened there? There's been two basic things which have happened from a revenue perspective. We have seen continued tough trading in our market. General merchandise continues to be very tough, both particularly in the UK where we're more mature, and that has sort of dampened trading in Q4. And we've also seen some deferral of European orders, European product launches from Q4 into Q1. Now, on that second point, we have had a lot of product launches in Europe over the sort of latter third of this financial year, but we have seen some of them deferred into Q1, and that's been quantified at about 4 million. We have seen in terms of mix. Overall growth. I mean, it's a story of 25. Really, growth in our European business and some decline in our UK business, and that mix has affected our gross margin. Our European business is typically lower margin relative to our core UK business. So, as a result of that, we are expecting lower revenue than expected, and gross margin to be softer than originally expected. So we're forecasting 12.5 million, around 12.5 million EBITDA versus the 14.3, which was the current consensus. I suppose the more significant news really is the sort of pessimistic view we're taking of FY26. At this point, we wouldn't draw too many conclusions from the order book. It's still relatively young, and at this point it can be volatile and it can be affected by timing. For example, orders placed, say, earlier last year than this year, and normally we'd wait until pre-close in August when maybe it matured a little bit, and we could draw perhaps a better informed view from the order book. We decided to, given that we were updating anyway, we've decided to give this view because the combination of that softer order book together with what continues to be, I think, for general merchandise a very tough market, those two together. We felt that we had to update and we had to give this sort of fairly negative view on FY26. Now, of course, that's what we're dealing with, but really that's not good enough as far as I'm concerned. No matter how hard markets are, you still have to trade in them, and we have to make sure that we get the best out of whatever market we operate in. So there's still an awful lot of products being traded each day, despite the fact that we know consumers their sentiments is somewhat muted. We know that consumers are choosing to save more and spend less. We know that food inflation still is still there, and that squeezes our half of the shopping basket, which makes things tougher. But all things aside, like I said just before, there's still a lot of product being bought and sold. We still have to take, more than our fair share, and it's caused us to go away really and think, well, what can we do? What can we do better here? What improvements can we make? And it's not dissimilar to what we've done previously in the face of, escalating costs that all consumer businesses have faced in the last couple of years. We haven't accepted that lying down. We've gone away and we've automated, and in doing so, we've mitigated that those inflationary effects on our overheads, so that overheads have stayed level for about 3 years on the run, despite significant escalation in wage rates. And it's the same with this, really. We've gone away and said, okay, fine, it's a tough market, but what can we do to do better in it, and what can we do to do better, particularly than our competitors? We've got, I think, a fantastic brand offer, a fantastic product offer, and we're universally, I think, acknowledged as being sort of the best at what we do operationally. What we need to do is do everything we can to sell that proposition as effectively as possible, and what we want to do is up our investments in the sales function, up our investments in training and development, in use of data and technology. Have a look at sort of process and how can that be improved to get the best outcomes possible in what is a difficult market, and that is the real key focus of the entire operating board and indeed main board at the moment. It's a tough market, but can we do more to get more out of what is a challenging market, and that's where our focus is going to be over the coming months with regard to our sales function. How can we get more out of the current situation? It's really as simple as that. I don't really, Hannah, have much more to say than that. It's quite straightforward. Any questions from your side?
What is the net bank debt position range going to be at the end of 2025?
End of 2025, the analysts are expecting it to be around 18 million. So relatively similar to what it was at the interims. I would have hoped for that to have come down a little bit more, but that's obviously been affected by these 4 million of deferrals. So we're holding that stock at the moment for them, which means that therefore, working capital is that 4 million higher than I would have wanted or expected it to be. But that should end up being traded out over the course of the summer. I would say in terms of our working capital position, it is still elevated by about 5 million due to the closure of the Red Sea. Obviously, I do hope at some point for the Red Sea to reopen for us to get that back, but I'm not counting on that anytime soon.
What is the sold stock balance range going to be at the year end?
Ooh, the sold stock balance level. I was expecting questions on free stock level, because free stock ends up being the risky stock within the business. Because the free stock level is the one which is relatively stable within the business. And the free stock level has been running at about sort of like 10 to 12 million. And if that was rising, that's what would cause me to kind of like have issues as a CFO, that was rising above the level I would want it to be. That at the moment is about 9.6. Our sold stock level, I'd be expecting to be slightly higher than that. So obviously that has got less risk in relation to it. That's probably going to be in the order of 16 to 17 million at the year end, which will obviously include that 4 million extra, which I would have expected to have sold.
Thank you. Is the 4 million of deferred orders from Q4 in 2025 included in the current order book for 26 and reflected therefore in the 7.5% fall stated on the trading update?
It is, yes. So those 4 million have moved into next year. So that was on one large customer. The irony is about it, they did a very big exercise of completely looking at the whole of their order book that they do, and they looked at all customers in relation to that. So what's actually ended up happening with this customer is orders have then moved out of 26 into FY27. So miraculously at this point in time, we actually have an order book for FY27. So about 4 million went from 25 to 26, and about 3 million went from 26 to 27 at that point. So having about a 1 million net effect on the FY26 order book.
Really helpful. Can you give more detail on what improving the sales function actually means?
Yeah, sure. And look, I don't want anyone to get the false impression that we have a problem with our sales function. This is not about that. This is about, can we do even better? So we're going to be we are focusing on probably four main areas. We need to make sure that we're making as good a use of data and technology as possible. We're pretty adept at that as a business as a whole. Possibly we're a bit less invested in that in the sales area. We need to really double down on training and development. When you're selling a brand, which and the business has changed a lot in recent years to be more branded, that requires a certain way that you need to go about that. So we need to make sure, and of course, sales is more typically about the soft skills. So train and train again. So that's going to be a top priority. And again, probably an area where, on reflection, a bit less invested in sales than elsewhere in the business historically. Process and management process. So making sure there's the correct the correct monitoring and oversight of the team on what they're doing, and making sure that what the team are working on, it really dovetails into the overall strategic priorities of the business. I don't think there's a huge amount to do human capital wise. I think we've got good people in there, but there may need to be some additional expertise brought in. We very much aspire from a sales point of view, and we've learned this from our two new non-execs, Andrew Milne and JC, who both from an FMCG background. Andrew is CEO of Nichols, so some people on the call maybe holders there, but he's from a sales and marketing background, and JC is from an FMCG background with the likes of Procter and Gamble. And it's really opened our eyes as we who are the best at selling and using sort of data and technology and the training side of selling. And we look at the FMCGs and your Cokes of this world, etc., and we see them as the example we want to follow. So we are it's that kind of thing. So. And it is a sort of all operating board sort of initiative. It obviously be led by myself and Simon Showman, but it's about addressing often a lot of small things that get in the way to sell and liberates them to do that. So people like Craig Holden, David Bloomfield, our trading directors are getting sort of heavily involved in this initiative. It is a very important priority for us.
And has Salesforce forecasting been poor?
I don't think our forecasting. Once we get those listings, we're able to forecast them pretty accurately. We want to get more listings. Is the important point.
Couple of questions asking, do you think the impact sale has come from Temu and Shein?
I don't. Well, to the extent it is, I think it's pretty marginal. Look, I think Temu, Shein obviously is more clothing than GM. Temu is really a threat to own label offers. Really people who shop on Temu shop because they're brand agnostic, and they're very happy to buy an unbranded product. We many years ago decided to focus on our brands. The people who buy our products value our brands, so we think they're much less likely to buy from Temu. It may have an impact, a marginal impact. So, for example, there are some small parts of our business where, say, like for example, cooling, when it comes to a 6-inch desk fan, people don't really care that much if it's Beldray or not. I suspect it may have a marginal impact, and therefore maybe in areas like that we would lose some revenue. But that's a very small part of our business. And interestingly, during this recent heat wave, we did see demand on those sort of commodity cooling products at a lower level than would have been previously. But the electrical cooling items, we did see a surge in demand because, when it comes to electrical, more people want the assurance of a brand.
Thank you. With debt EBITDA expected to peak at 1.8 times, how close is this to your covenants and how often are these tested?
So fairly far away from our covenants. So the covenants are up there at sort of like 3 times, and aren't also based on the full amount of debt that we've got. They're only based on part of our debt balances. So you can't take that as being the actual measurement at all, because it's only in relation to certain components of our debt. So they're measured on a quarterly basis, and we are very comfortable with sort of like where they are. Obviously, I spoke to our bank, and I spoke to our bankers yesterday, and so they are very well aware of what was sort of like, coming down the line sort of like today. We have a very good relationship with HSBC, and, all the models are showing at the moment that we work well within our covenants.
Okay. Questions on Europe, essentially. How's it doing? It was supposed to come to the rescue. How are we trading there?
So, if you take a step back, what was the plan, and where is that plan falling down? The plan was, in many ways, very simple: a stable or preferably growing core UK business, and a European business where growth was more elevated because we were relatively new entrants to that market. But where the incremental overhead burden was pretty small, so that the gross margin in Europe would convert into EBITDA, on a an 80p in the pound basis, say. So now where we're falling down is we aren't delivering that stable UK core business. So, I'm very confident that Europe will continue to deliver growth really for the foreseeable. We've got some very strong strategic relationships. The point about the 4 million, and you can take a kind of glass half full, half empty view of this. Yeah, I'd prefer to have that product invoiced in Q4, not primarily because of the impact on the numbers, although it was a definitely super close second. The more important reason is the quicker a product launches, the quicker you get your repeats. And so you get that repeat, it leads to overall a higher level of revenue in aggregate. So, but, that's the glass half empty view. The glass half full view is we had, a dozen or so launches anyway. They're now repeating. The retailer in question is we're doing product launches with them. Several product launches a month have been over the latter part of this year. Will continue to do so into H1, and ultimately that's going to be a significant driver of growth in Europe. But the problem is if we do that, but we see decline in the UK, then really we're pedaling fast to fill a gap, and that's what we've got to address, and that's why we want to kind of really double down on our sales efforts and see if there's scope for improvement there, because if we can make that stable, and growth would be even better, of course. And by the way, on the growth points, there's no reason why there shouldn't be growth. Our brands are still challenger brands in most of the product categories we're in. The only one where we're not really the challenger brand is Scales on Salter, where we have sort of 60% UK market share. So none of this should be a problem, even allowing for the fact that it's a pretty tough market. So if we can sort of stabilise that core UK, that then allows the confident growth in Europe to convert, into gross margin and then down into EBITDA, sort of with very little dilution. At the moment, because we're struggling to deliver that stability in the UK, we're really, the growth in Europe is to some extent filling a hole there, and it's also diluting our gross margin, which is what we've seen in H2.
Will further European expansion involve additional sales and marketing expenses in new territories?
I think gradually over time, but I think just to return to that point about, the incremental cost to serve of our European business, again, assuming a stable UK core is pretty modest. Chris and I think it's no more than 2% of revenue, and that's because we are leveraging the product developments that we've already invested in for the UK. It's because we're leveraging our operational capability here. So the incremental cost is generally just sales effort, and then I think over time, increasingly some marketing efforts as well. But it is yes. The answer to the question is yes, but it's going to be a modest spend relative to those incremental European revenues.
Was the customer who postponed the large order in the UK or in Europe?
It was in Europe, as I said before. Yeah.
Is there room for further cost cutting if sales deteriorate further?
Well, I think there's significant opportunity for further management of our costs. I've always got to be quite careful in a forum like this what I say, because the largest elements of our cost base is people. So I don't want to cause issues there, but our productivity programs continue apace. Rollout of robotic process automation, RPA, rollout of accelerating use of AI in the business, and then the recent the recent launch of the PIM, the Product Information Management System, has been a bit of a game changer, really, in terms of enhancing productivity throughout the business. So we do see ourselves, and this is super important, because what we're seeing amongst our competitors, how are they dealing with this? If you take sort of national living wage as a bit of a benchmark, it's got from since 2021, it's gone up by the best part of 40%, and we've managed to absorb an awful lot of those increase in salary rates through being more efficient through automation. We see our competition, often taking it out of the product, and that is, well, that's just not sustainable. At some point, the consumer notices, and it damages your brand. So I think we've done something quite special here on that front, and we continue to do so.
Okay.
I guess what I'm trying to say, it's not just an overhead play. It sounds like an overhead play, but it isn't really. It's about allowing us to be as low a cost as we want to be the lowest cost, highest service supplier to UK and European retailers, and and that delivers a commercial advantage, not just an overhead benefit.
Okay. You talked about competitors. Are you losing market share in the UK to other brands?
We don't believe so. When we speak to our competitors, they're saying similar things to us. It's a tough market, and then that's often magnified then if by the sort of reticence of retailers to place orders, because they're not sure what's happening. Uncertainty often sort of leads to inaction, and pushing pushing people over the line to place orders is definitely tougher now than it would typically be. Look, I mean, I am a bit concerned about FY26. Where our order book is down. Like I say, big health warnings. It's early days. There's plenty still to do. But the fact the order book is down relative, it combines with what is, everyone's kind of acknowledges as a tough market. It does worry me. But we'll give a further view on that when we do pre-close in August, when we'll have a bit more data.
Okay, and not competitors, but perhaps comparables. ProCook with results today. Marks Electrical recently reported favourable results, suggesting that today's profit warning from Ultimate is not connected to the general consumer market. Could you comment?
Well, I always find these questions pretty difficult because saying things about other people is. But I think those businesses are on a have gone through their own cycles, haven't they? Exactly. And I think are in a bit of recovery mode, and I'm good on them. We like both those businesses, particularly. I think from an operational standpoint, I think Marks Electrical. They fitted my dishwasher last week. Deliver a tremendous service. So it's the guy who founded it. I can't remember his name now. Who's I think is still the CEO. We hold that team in very high regard. So we're pleased to see them back in York.
Mark of Marks Electricals.
Yeah.
Is the UK softness primarily with discounters or supermarkets?
It's there aren't many people doing well on GM, so it's pretty broad spread. I'd say though it's certainly worse with, should we say, kind of smaller retailers, maybe retailers that are exclusively GM, maybe don't have a food offer. Food still gets people into the store. That'd be my sort of overall observation on that.
I mean, when our numbers come out for 25, we have done comparatively better in the UK with supermarkets this year, less with the sort of like the discounters and less with the smaller sort of like the retail. So supermarkets in FY25 have certainly held up better in that space by our numbers.
Thank you. Okay, I've got about 3 questions all around dividends, capital allocation. So 1, will you continue with share buybacks? 2, will you continue with the dividend? What's the thinking around that? And sort of 3, excuse me, with your current policy, capital allocation policy linked to EBITDA, does it not make it inevitable that more shares are bought at a higher price and less or none when the share price is lower due to a weak outlook?
So first of all, I mean, our capital allocation policy, if you don't know what it is, first of all, is to invest within the business for the sort of like for the growth in the business in the long term. It is then to distribute 50% of our post-tax profit. And then to supplement that as far as to keep net debt to EBITDA at around 1x with share buybacks. So obviously in terms of share buybacks, if we are sort of like significantly above the 1 on a sort of like a longer term, medium term basis, then yes, we would, see sort of like doing those. And that is a constant sort of like watching brief. We aren't wanting to get net debt to be going up and buying our shares. That's only for excess cash to be doing that. And that policy is to be buying in the market at what the market share price is at that point in time. And obviously we're a believer in sort of like that the fair price in the market is the fair price at that point in time. And that is a way to, in essence, as a distribution to shareholders, to give shareholders a different route. So, some shareholders prefer dividends, some prefer sort of like share buybacks. So we, do both in relation to that, in line with what our sort of like stated policy is.
Thanks. Is the guidance you've provided to brokers based on current freight rates, including the recent jump?
I'm not sure the recent jump is that's being referred to. I mean, we saw this sort of mini shipping crisis last year, which affected H1 results. We have seen an increase in rates Asia Pacific, but we don't tend to use that route. There's been a mild firming, but it's I would say it's pretty much within a normalized range. We did see rates. Spot rates go down, I think, as low as 1600s and the back above 2000. But our contracted rate is $2,000 anyway in a 40-foot. So
I suspect where the question may be coming from, I could be wrong here, but over the weekend there was stuff about sort of like tanker rates and sort of like the rates for tankers increasing, but that's specifically around oil tankers coming out of the Gulf due to the threat of the Persian Gulf ending up being closed, as opposed to the shipping that we are working with. But there has been press around those sort of like oil tanker prices.
Yeah. Okay, thank you. Do you still expect your online sales to grow?
Yes, I do actually. I mean, we've online was sort of most adversely affected by the air fryer boom and then it coming off. And there has been some changes around Amazon's sort of approach to intake. They've been tightening their inventory. We think that cycle should have come to an end by the time we get to peak. It's always quite a difficult question to answer this one without knowing what your October, November, December is going to be. It does have we were not a particularly peaky business. I mean, we do more revenue in our first half typically than the second half, but we're not like very, very sort of Christmas peaky. But our online business does tend to be. I'm pretty excited about what we're going to do in peak, particularly in the EU. We've been doing a lot of work over the last 12 months to improve our EU offer on the Amazon platform, and we're listed across all the main territories in Europe. More of a focus on Salter and Beldray, and that's moving well. But the real test is peak, and we'll So I am optimistic, but I'll give a more definitive answer once we've seen that peak trading.
Yeah, absolutely. A couple of questions actually on disposals. One obviously notes that the strength and focus is on Salter and Beldray. Do you need the rest? And the other notes that the price you paid for Salter is now 2/3 of your current market value. So do you have any views on what you're going to whether you would hold on to everything?
Yeah, I mean, we call the other brands supporting brands. And there are, it's the plan A is always Salter and Beldray. They're the brands that we invest in from a marketing perspective. They're the ones with the heritage, the consumers, love and recognize. I use the word that love. We went to the Good Food Show last year, and you bloody hell, people really love Salter. It's remarkable. But you do need from time to time a bit of a plan B for in terms of channel management reasons. There are times where it would not be appropriate. There's a good commercial opportunity, but it wouldn't be appropriate to use one of those two brands. But we do see Salter and Beldray as are very much our main area of focus.
Okay, thank you. When you talk about sales weighted towards lower margin product categories, what kind of categories are we talking about? Are SDAs also still weak?
So we do have a range with sort of like within sort of like when we talk about product categories. So last year, it is true to say we had a relatively large amount of clearance sales, which are relatively one-off and a relatively high margin. We don't have those same clearance sales in the current year. And then within our sort of like main product categories, yes, SDA are at the lower end, houseware, sort of like, kitchenware in the sort of like the middle, then scales at the higher end. So yes, you can have a sort of like shift between those, and it has been shifted slightly more down towards the SDA level. And also it's sort of like going, the customer mix as well, or sales channel mix, has also been slightly more towards the lower end. And then in relation to geographical, it's also been a slight shift towards the lower end. So EU versus the UK, when Europe has been growing, but UK has been going down. So almost all three of those areas are weighted towards the lower end, which means that overall the gross margin mix has been towards the lower end, which almost you'd like to kind of like go, there is one driving reason behind it. In the first half of the year, the driving reason was freight. Really very easy to explain because you can see what's going on. Second half of the year, it's slightly more complex in terms of those moving parts, but in some way, as Andy explained it earlier, you want that UK core to be stable, and with the EU, which is slightly lower margin, to be adding the growth to it. That model doesn't really work if the UK is shrinking.
Are you seeing any change from Chinese exports being redirected to the EU and UK from the USA?
Not really. This was the sort of big news story, wasn't it? There was going to be a load of product arrived that was originally intended for America. It was always a bigger threat in theory than it was in practice. It's not that straightforward to repurpose product for the US market for Europe. So, to use a very obvious example, the electrical products have a different plug and indeed a different voltage. So it was always a bigger threat in theory than in practice. The stock that was sort of left in China when the tariffs went up basically remained in factory warehouses, and then when the 90-day window was open, it was all shipped. So, I've no doubt there will have been some product that made its way to Europe and to UK, but we've not seen very much of this.
Thank you. What's the good medium-term gross margin target?
I mean, target is an interesting word because, to be honest with you, it's not necessarily what I'm targeting. It's because what you end up with the mix. I mean, what we want to do as a business is to grow the top line, and therefore, when I'm sort of like talking to the analysts and sort of like they're sort of like setting expectations, you are trying to kind of like come to what you're expecting a blended rate to be. Usually I'll be expecting the blended rate to be sort of like around 24%, but you can sort of like see shifts in that. So obviously this year, slightly lower down at 23, last year sort of like slightly higher at 25. I wouldn't say I was necessarily targeting that, because if I can see that the growth is coming from an area where I've got a slightly lower gross margin, I'd be happy with higher sales, higher gross profit overall, and a slightly lower gross margin as a percentage, if that makes sense. So what we're trying to do is grow top line, grow gross profit, and then the gross margin ends up being a little bit of a ending sort of like calculation. But if people are looking about what rate I'll be expecting it to be, I'll be wanting it to be around 24%.
Thank you. And just back to the tariff point, can you leverage perhaps reduced demand from the US to get keener pricing from your Chinese manufacturers?
Yeah, so I mean, there is some good news here, which is very welcome. I think a couple of things. Yeah, I mean, factories are quieter, so that gives us a stronger negotiating position. And I think also America is definitely fell into, as far as Chinese manufacturers are concerned, is definitely in, unreliable boyfriend territory. Even if it all switched back on tomorrow, back to what it was, which I think is unlikely. I think you'd see Chinese manufacturers being quite skeptical about, wholeheartedly reinvesting in those relationships again. They are prioritizing, the other markets like Europe and UK. So that's quite helpful. Also, and I know there's been some bouncing around in the last few days with things like oil prices with the Iran crisis at the moment, but a lot of input prices have dropped, relative to say a year ago. So that's quite helpful. I think there's perhaps a bit unnoticed is there's a bit of a double whammy on the currency front potentially. The Chinese renminbi is depreciated against the US dollar, but then the US dollar in turn has depreciated against pound and euro. So there's a bit of a double benefit there. So we are seeing better factory gate prices, and then of course we are seeing a better GBP US dollar rate and indeed a better EU US dollar rate. Obviously, with that part of our currency, it will take a while to come through because our hedging positions would need to unwind to get the full benefits of that. So it'd be certainly we'll start to see the benefits of that during the course of FY26, but more so in Q4 than in Q1, should we say? The benefits will build as we go through the year.
Okay, just trying to wrap up here, and there's quite a few questions around just the rebrand and how have the sort of Beldray rebrand been received? Has the rebrand been part of perhaps the drag if people have seen the rebrand as an opportunity to sort of exit on the basis of their own woes, or has the rebrand going to be, or will it be the opportunity to translate into increased listings and sales?
So in terms of the Beldray rebrands, it's only partly in the market at the moment. But the response to it from retailers has been exceptionally positive, and they do see us very much as a credible now competitor with the other laundry brands that are out there. So because it was a more radical rebrand than Salter. Salter was more conservative because the consumer knew what they wanted from Salter, and we just had to align ourselves with that. Beldray was a more of an opportunity to put our stamp on the brand. I think it's absolutely stunning, and that's certainly been the feedback we've had off retailers. But the true test will be once it goes into store and hopefully delivers increased profit density for those retailers and therefore reorders.
Super. Okay, well, we're going to have to wrap it up there, but we've had over 50 questions, so apologies if we didn't get into the nitty-gritty of all of them, but I hope that gives you all a really helpful bit of substance on today's trading update. So thank you both, Andrew and Chris, for your time, and for our listeners for joining to us, and we'll look forward to further good news in the future.
Great. Thank you. Thanks, everyone.
Thanks very much.